I want to introduce Chris. Chris is as I said earlier, owner of CB Smith and Attorneys. He was a graduate of Georgia State University. For 13 years, he was in industry, working for publicly traded companies as a controller. And in 2003, he opened up his office in Forsyth County and has been working with small to mid-sized business as a CPA and growing his firm. All in all, Chris has been an accountant for 25 years, and he has some good information that will help our small businesses with navigate some of the issues coming up with accounting in the current environment. So with that, Tom, I'm going to darken our screens and our mics, and Chris, you've got the floor.
Okay. Welcome. Again, my name is Chris Smith, and I'm the owner of CB Smith & Associates. We're an accounting firm dedicated to closely held businesses and individual taxpayers. We are headquartered here in Cumming and have two other office locations in Macon, Georgia, and the Lake Oconee area. Thank you for joining me today for what I hope will be an informative discussion on the federal government's response to COVID-19 and how it impacts you. Let me open by stating that our highest priority at CB Smith & Associates is for the safety, health, and financial well-being of our clients, our employees, and the communities we serve. We feel the best way we can achieve these priorities is through education, guidance, and consultation, and providing assistance to our clients who need it the most. Our goal for this webinar is to highlight various aspects of the legislation that has passed thus far, with an emphasis on how it impacts you as a taxpayer and as a taxpayer and small business owner. As Scott had mentioned, as we conclude the presentation, we'll take a few minutes to answer any questions you have. Please feel free to type those questions in the chat section of this webinar, and with time permitting, certainly I'll answer as many as I can. So let's get started. We all lived in a very different world 2 months ago. It has been very difficult for us as fellow taxpayers, accountants, and CPAs to change our mindset with respect to the tax deadlines that we have lived with for most of our lives. In retrospect, we're pleased to see the foresight the federal government had in extending the deadlines back to July 15th of this year. There are three items I would like to highlight with respect to the tax deadlines. One, no extensions are needed. All April 15 deadlines for returns and payments have been pushed back to July 15th. Two, these deadlines also apply to estimated tax payment requirements. The first and the second quarter estimated tax payments are due on July 15th. Three, the May 15 tax deadline for tax-exempt and nonprofit entities has not changed. If you are affiliated with one of these entities, please be mindful of this deadline. In addition to the change in deadlines, there are a number of tax law changes that have been implemented and passed with Phase 2 and Phase 3 legislation of COVID legislation. I will first focus on the individual tax provisions. The individual recovery rebate. Many of you have already received your rebate via electronic payment. This is actually an advance of a rebate that has been created with the 2020 tax year. If you have not received the payment, it could be due to the phase-outs that are in place with respect to your filing status and your income level. Each household will receive $1,200 for each taxpayer in the household and $500 for each dependent under the age of 17. If you are filing single and you earn less than $75,000 a year, you will receive a payment. If you are filing jointly, and you earn less than $150,000 a year, you will receive a payment. If you are filing head of household and you earn less than $112,500 a year, you will receive a payment. As your income exceeds those thresholds, the payment amount goes down $50 for every $1,000 earned. This means that payments fully phased out at $99,000 for single taxpayers with no children and $198,000 for joint taxpayers with no children. 2019 and 2018 tax returns will be used to calculate the rebate advanced to taxpayers. But taxpayers eligible for a larger rebate based on 2020 income will receive it in the 2020 tax season. Taxpayers with higher incomes in 2020 will see the overpayment associated with their rebate forgiven. For example, a single taxpayer with $100,000 in 2019 income would not receive an advance rebate, but would receive the $1,200 credit on their 2020 tax return if their income for the year fell below the phase-out. On the other hand, a single taxpayer with $35,000 in income receives a $1,200 advance rebate, but would not have to pay that rebate back on the 2020 return if they made $100,000 for that year, for this year. Typically, charitable contributions are deducted off of the adjusted gross income as an itemized deduction on your tax return. If your total itemized deductions do not exceed the standard deduction, most taxpayers cannot take advantage of those charitable contributions. The CARES Act allows a taxpayer to deduct up to $300 in charitable contributions before itemized deductions. Excuse me. And are taken as an adjustment to gross taxable income. During these times of need, it is important that we support nonprofits in our communities. With this tax provision, taxpayers will be able to take a full deduction for any contribution up to $300 they make to a charitable organization, whether they itemize or not. These are trying times for both individual taxpayers and small business owners. Many of us are experiencing reduced income and need cash for our families to pay mortgages and send our children to school. The CARES Act has added a provision that allows you to waive additional tax on early retirement withdrawals for any withdrawals up to $100,000 during the 2020 tax year. As such, if you were to withdraw $100,000, you would save $10,000 in tax from this waiver. Be advised, however, that funds that are sitting in your retirement accounts are pre-tax dollars. Any funds that you pull out of these retirement accounts will be subject to ordinary income tax rates. The good news is that the distributions you do take out will be subject to those taxes over 3 years. Additionally, you can recontribute the funds back into your retirement accounts within 3 years without regard to the yearly cap on retirement plan contributions. Many larger employers provide student loan repayment assistance to their employees. These payments typically are taxable to the employee. This provision of the CARES Act of this particular law allows the payments to be excluded from taxable income for the employees, yet still be tax deductible to the employer. Now, let's go over some tax provisions for businesses related to COVID-19 legislation. The Tax Cut and Jobs Act of 2018 eliminated a taxpayer's ability to carry back net operating losses. The CARES Act reverses that provision and reinstates carrybacks for NOLs incurred in 2018, 2019, and 2020. Those carrybacks may be carried back up to 5 years for refunds of prior year paid taxes. If you know you had a loss in 2018 or 19, reach out to us. It may be to your benefit to carry those losses back. Go back one. Additionally, there is a limitation that has been lifted with respect to interest expense. Typically, interest expense is limited to 30% of earnings before interest, taxes, depreciation, amortization, oftentimes referred to as EBITDA. The CARES Act temporarily lifts that limitation from 30% to 50%. CARES Act also made a technical correction for an accelerated depreciation tax deduction that was left off of the Tax Cuts and Jobs Act of 2018 inadvertently. This provision allows businesses to fully deduct any improvements they make to the interior of their business's buildings. The CARES Act also added a provision that isn't really a tax deduction, but more of a deferment of tax payments. For the 2020 tax year, a taxpayer may elect to delay their employer side of the Social Security payroll taxes. Normal tax payments are reinstated effective January 1st, 2021. If you elect to delay your payroll tax payments, 50% of those payments would be those payments on the payroll taxes owed would be due on December 31st, 2021, and the second 50% will be due on December 31st, 2022. Now I'll go over some provisions that have been put in place related to human resources and payroll. First, let's address the state of Georgia. As an employer, if you are furloughing or reducing hours for your employees, you are required to file unemployment claims on behalf of your employees. Any employer found to be in violation of this rule will be required to reimburse the Georgia Department of Labor for the full amount of unemployment insurance benefits paid to the employee. So back to the federal provisions. There are two payroll tax cuts that have been put in place with COVID-19 legislation. The first was signed into law with the Family First Coronavirus Response Act, Phase 2. It permits small and medium-sized employers with fewer than 500 employees to begin taking advantage of two new refundable payroll tax credits that are designed to immediately and fully reimburse them, dollar for dollar, for the cost of providing coronavirus-related leave for their employees. Employees may receive up to 80 hours of paid sick leave and expanded paid child care leave when employees' children's schools are closed or the child care providers are unavailable. This credit is limited to 80 hours for each employee. Additionally, the employees need to show that they cannot work from home due to these circumstances. The second tax credit that was signed into law was the CARES Act. Business owners, regardless of size, whose operations have been fully or partially suspended by government order, or who have seen a significant drop in income of more than 50% compared to the same quarter in the previous year, may be eligible for the employer retention credit. The credit consists of 50% up to $10,000 in wages paid by an eligible employer whose business has been financially impacted by COVID-19. Qualifying wages include those paid between March 12, 2020 and January 1st, 2021. Notably, though, accepting a loan from the SBA via the PPP Loan program will negate the employer's ability to claim this credit. This can be particularly problematic for some business owners who can actually stand to benefit more from this credit than they would by taking the PPP loan. Funding options. There are two primary funding options with COVID-19 legislation thus far. The first is the Economic Injury Loan Disaster Program, oftentimes referred to as the EIDL program. Unfortunately, the EIDL program is currently suspended due to lack of funding. There was a second tranche of funds that were released just recently last week for both the PPP and the EIDL. Unfortunately, the additional funds that were related to the EIDL was not enough to allow for any more applications into that program. So as of today, that program is not available for any small business owners thus far. It remains to be seen whether or not in a Phase 4 legislation they will introduce some more funding for that, but as of right now, there is no funding. What I will do is talk to you a little bit about the program in case it does get reenacted or get refunded, get some more funds appropriated towards it so you know what's available to you there. In comparing the Economic Injury Disaster Loan Program, or the EIDL program, to the PPP loan program, it is more difficult to qualify for a loan with this program, in that the borrower must show that they have been injured by the economic disaster. They show how they've been injured by the economic disaster that has occurred. However, by applying, you do qualify for an advance of $10,000 that does not have to be repaid. If eligible, this program is for any small business with less than 500 employees, including sole proprietorships, independent contractors, and self-employed persons, private nonprofit organizations, as well as 501c19 veterans organizations. The loan proceeds may be used for payroll costs, including benefits, fixed debts, such as mortgage, rent, or leases, accounts payable, and other bills that would normally have been paid had the disaster not occurred. The rates for this loan will be at 3.75% for businesses and 2.75% for nonprofits. And the terms of this loan can be up to 30 years. The PPP loan program is a much easier loan to qualify for. The amount that can be borrowed can be up to 2.5 times the average monthly payroll cost measured over 12 months preceding the loan origination date. Payroll costs for the purposes of this loan are defined as salaries, commissions, tips, or other similar compensation, employee benefits, including health insurance premiums and retirement benefits, state and local taxes only, and for sole proprietors or independent contractors, wages, commissions, income, and net earnings from self-employment, capped at $100,000 on an annualized basis. Payroll costs exclude, for purposes of this loan, any wages over $100,000, any wages paid to foreign employees, and it does specifically exclude federal payroll tax payments. The loan may be used for payroll costs, including benefits, interest on mortgage and rent, and utilities. The full proceeds of the loan may be converted to a grant for expenses within 8 weeks, within an 8-week period from the loan origination date. Eligible expenses would qualify for the grant include payroll costs, as I previously described, payments on mortgage interest, rent, and utilities. One particular note on the loan forgiveness: it will be reduced if you decrease the number of full-time equivalents or decrease salaries and wages by more than 25% for any employee that made less than $100,000 annualized in 2019. You have until June 30th, 2020 to restore your full-time employment and salary levels for any changes made between February 15, 2020 and April 26, 2020. This loan has an interest rate of 1% for all borrowers and has a term of up to 2 years. A special caveat of the loan is that payments and interest are deferred for 6 months. Please note that if you applied for both programs, they cannot be funded or used for the same purposes. For example, if you receive funding for the PPP loan, any proceeds you have received from the EIDL program for payroll, rent, or utilities will be refinanced into the PPP loan program. However, payments for accounts payable, other fixed debts, and other bills could be funded with this loan and be supplemented with a PPP loan. We are here to help you through this complex and rapidly changing environment. Whether you're considering the EIDL, PPP, grants, or other financing, our staff are ready to help you navigate the process. We will work together with you to understand your unique situation, strategize on immediate business decisions, and help you pull together the information necessary for you to submit your loan application. On this slide, you will find a number of different resources that are available to you to help you educate yourself on the options that are available to you. through either the Small Business Administration, the Georgia Department of Labor, or the U.S. Treasury Department. You can also find some additional resources, blog posts that we've posted out there, and other links on our website at cbsmithcpa.com/COVID-19. Additionally, if you have questions or you'd like to reach out to one of our accountants, you can email us at covid19@cbsmithcpa.com. And that concludes our webinar. For any questions?
All right. Thank you, Chris, for that information. I have a question myself. My wife and I haven't received any of that stimulus money that you were talking about. Is that normal?
So there are some folks that have not received it. What we found is that if you have been filing your returns multiple years, particularly in 18 and 19, and maybe you owe taxes and you decided you wanted to write a check to the IRS, they don't have any kind of account information for you if that is the case. If, on the other hand, you feel that they do have your account information, because you've received tax refunds in the past via electronically, you probably want to go ahead and check your income levels to determine whether or not you have phased out of that program based off of your income levels either in 2018 or 2019.
Okay. Thanks.
Yep. For those that may have, they feel that the IRS does not have their account information, they can go to irs.gov, and there's a link on that website for them to give the IRS that information, or they can wait. They'll receive a check in the mail.
Chris, when I'm trying to show, not that I've gotten any of these loans yet, I've applied, but when I'm trying to show how I used them, at first people were saying set up a separate account and then draw off of that. Other people were saying, no, you can just do it through QuickBooks to say I paid this payroll, I paid this, and this accounts for the loan. What's your advice on making sure that they're going to accept whatever documentation we give to prove how the funds were used?
Yes, that is a big question that a lot of folks have had. They're thinking that they need to segregate those funds. So really, there's a couple items that you need to be aware of. First off, the Treasury Department has put the onus on the banks to determine whether the loans will be forgivable and how much of the loans will be forgiven. So that is a task that they have delegated over to the bank financial institutions. So the financial institution you have gotten the loan from, once you have met the qualifications for forgiveness, you will be submitting that information to them. And so one of the issues you're going to run into is, depending on who the financial institution is, they're going to have different procedures in place in terms of what you need to provide to them to verify that information. For the most part, when you do apply for the loans, you're submitting copies of your 941s, your quarterly tax returns, and you're also providing them with the number of employees you had during that time frame. My guess at this point in time is that for the most part, you're going to see most of these financial institutions are going to be looking for some sort of payroll reports and tax returns that have been submitted that substantiate the amount of money that's been spent. They also will probably want to see copies of checks for rent that had been paid, as well as invoices and copies of checks for any utilities that have been paid. So there isn't necessarily, in my mind, there isn't necessarily a need to segregate those funds. What they're looking for is that the spending you have over the 8-week period or even longer, because they're even saying that you can recover those costs up through June 30th. So if your spending is currently down, but business picks back up at some point in time and you're able to show that over an 8-week period of time you're able to recover those costs, then that's all you're going to need to do is just substantiate those costs. And it's either going to be in the form of rents, utilities, copies of those, copies of health insurance benefits that were paid, retirement plan contributions that were made, as well as payroll tax returns. for probably the first and second quarter of this year.
Okay, thanks a bunch.
Yep.
All right. Well, if there's no more questions, then we're going to close out. Thank you, Chris, for this information. I appreciate you answering my question as well.
Yes, absolutely. If there's anything we can do to assist on getting those PPP loans, please feel free to reach out to us.
Everybody have a great day. Stay well.